Hey there and welcome. Today, we're going to look past those big, flashy headlines to understand what really makes a company tick. We're going to learn how to read its financial report card so you can see its true health. Let's dive right in.
So, let me start with a question for you. Imagine you see a headline, a company just hit $1 billion in sales. Wow, right? Your first instinct is probably to think, they're absolutely crushing it. Maybe I should invest. But is that really the whole story? Well, the short answer is, not necessarily. That huge sales number, that's just chapter 1. The real story, the one that tells you if a company is actually built to last, is all about profitability. Look, it's not about how much money comes in the door, it's about how much of that money actually stays.
Okay, so here's our game plan for today. We're going to start with the real profit story. Then, we'll follow the money as it makes its way down through the company. We'll ask if its assets are really pulling their weight, figure out what a single share might actually be worth, and then, at the end, we'll put it all together.
All right, first up, the real profit story. This is where we're going to blow right past that big, shiny sales number and start asking the questions that really matter. And to do that, we're going to follow the money down what I like to call the profit funnel. Just picture it. All that sales revenue gets poured right into the top of a giant funnel. Now, as it goes down, expenses start getting filtered out. The very first filter is our gross profit margin. This is simply what's left after you pay for the actual stuff you sold. It answers a really basic question. Is the company any good at its core job of making something and selling it for more than it costs? Okay, moving one level deeper in the funnel, we get to operating profit margin. This takes that gross profit and then filters out all the other costs of just, running the business. We're talking marketing, salaries, rent, the whole shebang. This tells us something broader. Is the company's entire day-to-day operation actually profitable? And finally, we get to the very bottom of the funnel, net profit margin. This, right here, is the ultimate bottom line. After you've paid for the product, paid to run the business, paid the interest on your loans, and paid your taxes, what is actually left over? This number is gold. It tells you for every single dollar in sales, how many cents are pure profit.
Now, this is where it gets really interesting, because we can see this funnel in action with some actual numbers. Let's say we start with $1.8 million in sales at the top. Great. But after the cost of goods, only 19.4% is left. Then, after all the operating costs, that shrinks again to 10.6%. And by the time you get to the very bottom, the net profit is just 4.5%. It's a really powerful way to see how that massive top number gets whittled down.
All right, so we've got a handle on how to measure profit, but that's really only half the story. The next huge question you have to ask is, how efficiently is the company making that profit? I mean, are its assets, all its cash, its buildings, its inventory, are they just sitting there or are they working hard? This is all about measuring efficiency. And the first tool we're going to use here is return on assets, or ROA for short. I want you to think of this as a report card for the company's management team. It measures how good they are at using everything the company owns to generate a profit. A high ROA usually means you've got a sharp, efficient team at the helm. So for the company we're looking at, the ROA is 4.76%. What does that actually mean? Well, to put it simply, for every $100 of stuff the company owns, it's generating about $4.76 in profit. Now, is that good? Is it bad? That really depends on the industry. But at least now we have a concrete number to start with. All right, next up, let's talk about return on equity, or ROE. Now, if ROA is the report card for the managers, think of ROE as the report card for you, the investor. It hones in on the money that shareholders have put into the company and asks a simple question: what's the return on our money? For any owner, this is a critical number. And whoa, check this out. Our company's ROE is 11.17%. That is more than double its ROA. So for every single dollar the owners have invested in the company, they're getting back over 11 cents in profit. And that raises a really important question. How? How can the return for the owners be so much higher than the return on all the company's assets? Well, the answer to that how lies in this really brilliant diagnostic tool called the DuPont model. It's fantastic because it doesn't just give you a number, it breaks it all down and tells you the story behind the number. It shows you exactly what levers the company is pulling to get that return. See, the DuPont model shows that ROE is really driven by 3 key levers. First, you've got profitability. That's just the net profit margin we already talked about. Second is efficiency. Basically, how good are you at using your assets to generate sales? And third, and this is often the secret sauce, is leverage. This measures how much a company uses debt to finance its assets, which can seriously multiply the returns for shareholders.
Okay, so we've got a good grip on what's happening inside the company. Profitability, efficiency, all that good stuff. But how does any of this connect to the actual stock price you see trading every day? Let's build that bridge and talk about what a share is really worth.
And the place we have to start is with earnings per share, or EPS. It's pretty much exactly what it sounds like. You take the company's total net profit and you divide it up evenly among every single share of stock. Honestly, this might be the single most watched number on Wall Street when a company releases its earnings.
Now, you're usually going to see two different flavors of EPS, and it's really important to know the difference. Basic EPS is the simple, straightforward calculation based on the shares that exist right now. Diluted EPS, on the other hand, is more of a conservative what-if number. It pretends that all potential shares from things like stock options have been created, which would spread the profit out a bit thinner. Smart investors always check out both.
And once you know the EPS, you can unlock one of the most famous metrics out there, the price-to-earnings ratio, or PE. It's a simple calculation. You just take the current stock price and divide it by the earnings per share. What this tells you is powerful. It shows you how much investors are willing to pay today for every $1 of the company's profit. It's a fantastic gauge of market sentiment.
And this really gets to the heart of why a high PE isn't always a red flag. It often means the market has really high hopes for that company's future. Investors are willing to pay a premium for the stock now because they believe those earnings are going to grow, and grow a lot down the line. It's basically a big vote of confidence from the market.
Whew. Okay, we have covered a ton of ground here. Profit margins, returns, efficiency, market ratios. So let's just take a breath and pull all of these ideas together into a practical toolkit that you can actually go out and use.
So here it is, your new financial toolkit. You use the profit margins to get a quick checkup on the health of the core business. Then, you grab ROA and ROE to grade the management team and see what the return is for owners. Feeling like a detective? Use the DuPont model to diagnose why those returns are what they are. And finally, you connect it all to the real world with EPS and the PE ratio to see how the market is feeling about everything.
So there you have it. You now have the tools to look right past those flashy headlines and understand the real financial story. So the next time you hear about a company on the news, or heck, even when you're just looking at the brands in your own house, ask yourself, what story is their report card really telling?